Have you ever wondered what gives Bitcoin its value and why it's more than just numbers on a screen? You see, Bitcoin is a new asset category, the cryptocurrency asset category. More broadly now, it's being called digital assets. And in fact, even the US government is referring to them as digital assets. This refers to things such as Bitcoin, Ethereum, some of the tokens built on Ethereum, and many other types of digital assets that we'll go into in more detail later on this channel. But this video is specifically for those people who are trying to understand what is this Bitcoin thing and why is it valuable. So, first of all, let's discuss briefly what Bitcoin is and compare it to other forms of money. So, historically, money has come in all different types, from things like marking value on a tally stick, which was common in Europe, to trading shiny shells, which was done by a lot of Native American tribes, and many other types of value exchange. And really, the reason for that came down to simplicity. If you are bartering, which was the standard way of doing things, where I trade something I have for something you have, that works to a certain point. But if you're trying to trade, let's say you have a cow and you want to trade a cow for so many goats. Well, maybe it's four goats to one cow, but maybe that's not what you want. So in the early days, this whole idea of money started becoming popular. So the idea of money is that you can buy or sell something without having another object or another thing to barter with. So it became an easier way to do it. So if somebody wanted to buy your cow, but you weren't ready to buy anything yourself, then you would get money. And that money then would be used to buy something you need later. And of course, everything would have a certain value. So in my silly example, the cow is probably worth quite a bit more than a goat. And so the market can determine, what are people willing to pay and what are people willing to sell it for as well. So that's the idea of money and very quickly explained. So, what is it about Bitcoin then? Well, as you know, today, most transactions occur electronically. So, although we talk about a US dollar, very little is transacted in physical dollars in the notes that are in your wallet or the coins in your pocket. It's really not that common, especially in the West. Now, there are some countries where cash is still king. It's still very important, but not so much in the West. So we're already in the West seeing the idea that electronic money makes sense. And why is that? Well, convenience. I don't have to carry around wads of cash, especially if I want to buy something that's fairly expensive. Also, I probably run a lower risk of being threatened and having, my cash stolen from me. It's much harder to do that, even with today's financial system using a credit card. But imagine if you didn't have to go through a bank to do an electronic transaction, where you could simply trade directly with someone else. In the Bitcoin world, we call that peer to peer transaction, meaning person to person. So even right now, if you're using a service such as PayPal or Venmo, it still goes through a bank and everybody takes their cut. There's a little cut that goes through everywhere, right? So Venmo takes their cut, the bank takes their cut, and it may or may not be obvious to you at the time. There are some ways to use those services, quote, for free. But in general, if you're paying transactional fees, if you're using a credit card through those services, you're paying anywhere between 2 and 4% for that privilege, or the merchant is paying that, which drives up prices. So imagine then if you didn't have to go through a bank. And that's the magic, basically, of Bitcoin and the blockchain. So the blockchain is something you probably heard about before, and it's intrinsically linked to Bitcoin. So Bitcoin is the denomination of value or the currency. And underneath it is the ledger that records all the transactions. We call that the blockchain. Now, the blockchain is integral to all cryptocurrencies. And in fact, it's probably the major development that has allowed cryptocurrencies or digital currencies to exist. Because what it does is it takes the place of a trusted third party, meaning a trusted bank or a trusted credit card issuer. And rather, it allows two people who don't know and probably don't trust each other to transact in a trustful way. So the blockchain actually creates a trust environment where you don't have to trust the other person. You can trust the ledger. You can trust that if a transaction gets recorded in the ledger, it's immutable. It cannot change. And generally, that's the way it works. So those are some of the real major considerations when it comes to Bitcoin. Now, by now, you may have heard that there's a lot of other cryptocurrencies. Uh, there's Ethereum and Solana and many, many others. In fact, there are thousands. But Bitcoin was the first, and it's the model for all the others. So let's talk a little bit more about Bitcoin so that as we talk about other cryptos in the future, that you'll have a good reference point. So one of the things that makes Bitcoin so interesting is that you can't just copy a coin. In other words, you can't just copy the digital information because of the blockchain. So in the past, one of the problems with digital money is that you could basically photocopy it or make a digital copy of it, and a digital copy would look exactly like the original, and therefore presumably you could spend it again, right? So you could just have, let's say, $1 worth of Bitcoin and just keep making copies of it. But that was obviously thought about right at the beginning, and the blockchain actually prevents that through various mechanisms, including encryption. That's actually one of the reasons why digital currencies are called cryptocurrencies. Crypto meaning encryption. Bitcoin was also created with a limit with how many Bitcoins would ever be created. And in its code, in the algorithm itself, only 21 million coins can ever be created. And that is the limit. And so many coins get created every day currently, and it trails off over time. And it's anticipated that by 2040, basically all the Bitcoins will have been mined or created. Now, what makes Bitcoin resilient is that it's not dependent on any clearinghouse or any centralized server. For example, if you use your Visa card or MasterCard, it has to go through some centralized servers, these huge data centers, and all your transactions have to go to one or more of their centralized centers or the centralized data facilities. That's not true with Bitcoin or other cryptos. And in fact, everybody's computer can be set up as a validation computer, as a validation node. And this idea of a node means that, much like the internet, there's no single point of failure. All these different computers come together at their own election, at their own choice, to work together to process transactions, to encrypt them, and there's this concept of consensus. So the majority of the computers on the network have to agree, which prevents bad actors from doing something that you wouldn't want to happen to your Bitcoin. So the idea of this decentralization means, if there's a power failure in an entire country, that's not a problem. The network, the Bitcoin network, continues in all the countries in which there are computers that continue to run as these nodes, these cooperating computers that work together in a decentralized manner. So that's another big consideration for Bitcoin. We're moving from centralized big data centers to decentralization, where the individuals and companies as well that can create these bitcoins. Anyone can participate. That all of these eliminate the single point of failure. The other great thing about the blockchain is that it's transparent, meaning that not only is it secure, but it's also visible. So it's not hidden like in your bank. Your bank, you may not know all the transactions your bank is doing behind your back. But that's not possible in Bitcoin. Every single transaction must be published on the blockchain to be valid. Now, there is a bit of an exception there. And the exception is that a basically an account number, or what's known as a Bitcoin address, is how each transaction is tagged. Now, that's a little bit different than attaching your name, which is good for security. However, if anyone finds out that that address is connected to you, then they can follow the whole stream of transactions, all the transactions that led up to you getting the Bitcoin, and everything you've spent or sent the Bitcoin for. So if you spent some Bitcoin to buy a car or a house, they'll know that anybody would know that those Bitcoins were transferred to another party. So that's another great benefit where it's transparent. When people say that, if you have Bitcoin, you're safe because no one knows, that's idiocracy. That's not true. That is just a lie. In other words, every single transaction is there, and the tools, especially artificial intelligence tools, are making it much easier for people, whether they're law enforcement or data brokers or other people, to track your entire history. Once they know one entry point for your address, in other words, if they know your account number on the Bitcoin network, that that's all they need to know that those Bitcoins are in your wallet. So ultimately, anybody can know how many Bitcoins you own if they have your address. So, but knowing does not allow you to steal them, grab them, take them, spend them, any of that. Part of the security of the Bitcoin network is you need the equivalent of a password. We call that a private key. That's how you manage your assets. You need this private key. Now, in the traditional electronic money sense, you don't need a private key. You need like a driver's license, or you need proof of your bank statement or something with your bank, and then your bank gives you that privilege. But in the blockchain and Bitcoin world, there is no third party. So you become your own bank. And by that, I mean, it's up to you to manage this password or set of passwords that gives you access to all your Bitcoin. No one can spend or send that Bitcoin to another party without that keyword, or that, again, that private key. So that this is like your password to all of your Bitcoin. And basically all of the other cryptos work in a similar way. So it becomes very, very important to secure that. We'll talk about that also on a subsequent video, because these keys are quite long and you don't want to just write them on a piece of paper, right? So there are more advanced ways to keep that information secure. The other interesting thing as we continue looking at Bitcoin in comparison to traditional money is, especially if you're in the US or Europe, governments and central banks print and print and print money. Now, they're not actually printing money. They're not actually creating lots of little pieces of paper that we call money. They're just adding these digits to a ledger that they manage. So they add it to the US dollar ledger or the euro ledger. So that's interesting, because what that means is inflation is inevitable. Because if you're creating money faster and faster, as we're seeing certainly in the United States right now, that means that there are more dollars going after fewer goods, which means over time, all of the costs of goods will increase. And that's just the way economics traditionally works. If you look, though, at Bitcoin with a ceiling of 21 million coins, there's a very high probability that the value of each Bitcoin will continue to go up for quite a long time. Because if there's fewer Bitcoins and more people who want them to buy things or to invest in them, well, then the value will go up. And in fact, we've seen that happen since Bitcoin launched in 2009. In 2009, it wasn't publicly traded, but by 2010, 11, 12, people were starting to trade it. And back then, it was just a few cents. The latest update here in 2024 is that it's reached and passed $70,000 in US dollars. Now, some of that is inflation of the dollar, but Most of that is the value, the increasing value of Bitcoin. So that's been a huge positive for Bitcoin, and it's created a lot of attention because of all its great um, characteristics, its benefits that I've been talking about. So, in closing, I hope this gave you a brief overview of what Bitcoin is, why it's important, and how it compares to other money. Note that Bitcoin is called a cryptocurrency, but not all digital assets are used as currencies. There are many different other uses, such as utilities and what they call NFTs or non fungible tokens, which refer to specific unique things. For example, you can imagine that a specific token could refer to the ownership of your car or the proof of title of your house. These kinds of things are coming, and the idea of managing everything on a blockchain that makes everything public. So it becomes very easy to say, oh, okay, I have proof positive that I own this house, right? So these are other things in the Bitcoin or certainly the blockchain world that are coming. So I really encourage you to continue learning. Subscribe to this channel, the Bitcoin Tutor. We work hard to try to make sure that people who are new to Bitcoin have the information they need, and those who have been in crypto for a while have some of the updates they need, whether it's taxes or new types of cryptos and new types of investments. So I look forward to seeing you on a future video. Thanks.